There's a place.
Hi everyone, and good to have us in this session today. Yes, it's weekend, and once again, big welcome to Time Out with Victor on Financial Modeling Bootcamp. And I trust it has really been a great experience for every one of us, and thank you for being active as well. So, welcome to our section. I think this should be session 5, right? Right, don't mind me, I'm kind of losing count, but this should be session 5. Yeah, right. Someone should confirm. Someone should confirm if I'm right. Okay, all right. So thank you for that. Thank you. So a big thanks to our sponsor once again, the Brown Consulting, Microsoft, and then our Microsoft MVP, and also my colleague Adidolamu Shogilola who will be coming in to take us on the evaluation part. So today, let's take a look at let's try and round up our building calculation blocks and schedule. Then we try to create our monthly financials and then try to consolidate that into our yearly financials as well. Then we'll be accomplishing that with some of our interesting activity. So let's get started. Let's get started where we stopped last session. Okay, saying I should try to help us increase my volume. Are you sure it's not from your hand? I think it should be from your hand. Yes. Okay. Yeah, I'm kind of using my laptop audio is has been boosted and also did some setting on Zoom. So I'm quite sure my voice is clear. All right. So the last session we ended our stuff on building our users, and our own activity was for us to go ahead and build out the revenue part of the model. All right, and thanks to some of us that were able to do it. I know, yes, it's been a busy week and all those as well. So let's continue the revenue build part of it. So we build out our users part, and now let's go straight to the revenue stream part of it. So let me come straight to our calculations where we stopped. So this is for our users. So let me just copy these headings. Let me paste it here, and we call this our what? Our charges. So let's call it our charges, right? So then let me call this assumption linked. And remember, we were trying to work smart. So let me just type equal to. We need our deposits, our customer deposits, then loans to SMEs, and also investment facilities. All right, so let me copy this so that we can have the percent. Then let me try and be a little bit lazy. Let me look for one of these are formulas. Let me paste it here. So for some of us that we made attempts, I'm quite sure you, you already know this. So let me look at this is row 85. So I can just update it in my formula here, change this to 85. Right, Excel is such a great tool. Then let me copy this down, then everything should just copy, and we have that for the respective months. So we have all our charges linked already. So let's start with the build of our transaction part of it. So let's even call this our transactions, our charges and transactions, right? Then let's call this our what? So the first one will be our savings, and they're telling us that average savings expected per user will be 10,000, right? So let's bring that in, equal to average savings per month. Let me just copy that. Let me also work a little bit lazy. Let me copy this formula, let me put it here, and I think that should be what? That should be row 91. So let me just change this to 91, and let me format this. So please, you can always ask a question. And I also assume you made an attempt trying to do this during the during your own assignment time. So this is average savings per users, right? And we are saying how many users are we going to have for the saving part, which we've calculated up here. So let me link that up here. Let me link it and let me even put it. So let me put this so that we know that this is being linked. This is being linked. Then copy to the right. Then what is our total savings per month? So total savings will be now what? So our total savings will be the average savings per user multiplied by the what percent number of savers. So let's change this one to savings users. Savings users, and we know that this is more like our total. So which means this is more like average savings expected monthly for the period. I think this is a little bit small. Well, as I said, the whole thing is let's build the model out as a whole. Then we can then come back and start doing the necessary adjustments. And that time we're only dealing with the input part of the model. So this is average savings. So what's next? What next? Then let's go straight to our loans. Let's go straight to our loans. Okay, so average saving times. Yes, you guys did not remind me. So let me bring that in here and bring that in here. So let me call this our average savings per users. So let me copy the formula down. Let me look at the row 93. I'm quite sure you are now seeing how easy it is to even build a monthly model, right? Just kind of follow the standard, structure your model very well. So this means this our okay. So this is average savings per month. So let's just multiply this average savings multiply by this our average saving times that we have here. So even if they decide that okay, maybe average person should be able to save around 20,000 in a month, all they need to do is to just change this. All they need to do is to just change this into 2, and you see that will show in your model, and that's what we call flexibility in our model view. So for now, let's put it back to 1. So we're done with that. So the next thing is our loans. So our loans. So number 1, what is the average? Let's look the average loans per business. So let me also link that. Enter. Then let me work. I'll be lazy a little bit. Let me copy this. Let me just copy this formula. Let me put it here. For now, let me delete the multiple times. So that is 96. Okay, perfect. So this works fine. Then we have this average savings, the number of business. Let me link that with our users that we have up here. Copy, put that here. Right, then let's call this users for businesses / loans. Then we have that. So let's call this our total loans. Our total loans. Put this in our currency format. So we also need our average loan times. So let me link that average loan times. Just copy that. So average loan times, this should not be naira, this should be times. So let me call this times. Use the wrong unit, Libre. Is it okay to round users to a number rather than with decimal? Users, this Mr. Gwinga. You cannot have 0.2 person human being, right? You always have 1 person, 2 persons, 3 persons like that. Yes, so please, users should never be in decimal. There's no.
Thank you. Thank you, Victor. Because what you have there, for example, in January is 7.7 users.
So that's why we rounded it up. Yes, we are kind of using percent, and when percent multiply by something, you always have something additional like that. But just round it up. So at least to be on the safer side.
Okay.
Yeah, to avoid different questions. Why we use that 7.7 and all those things? Just when you are building your model, always set your mind to always reduce as much possible. Reduce unnecessary question as much as possible. All right, so our average loan times, let's see, that is row 98. So let me change it to 98. All right, so we are saying this is our average loan per business multiply by this, our average loan times. Then we have this. For the users, this is what we have, right? And here we're saying our total loans will be this multiplied by our number of businesses that loan is being given to. Now, there's something missing out. For people that did the uh, assignment, right? I intentionally left it out while we are building up our input worksheets. Can anyone tell us? Can anyone tell us? So that's why when you are building a model, as I said, most times it's way beyond the figures, way beyond the values you put in your Excel, right? It's about the thinking, the understanding of the industry. We are missing something out in this our loans. Can anyone tell us? Can anyone tell us? I think it was only one person.
Interest rates on
Uh,
loans.
interest rates. No, we already have that. We already have that. This is our loans. Loans to SMEs, and this is more like the rates we created for it. We are missing something out. We are missing something, and that thing is even very, very important. Okay, Michael.
What about cost of borrowing?
Cost of borrowing. We've already factored that in. The cost of borrowing is the same thing as interest rate. Thank you, Daniel. We missed out our loan tenure and repayment period, because this person you are giving loan today definitely will not pay back this loan today, right? So which means we need to build a flexibility. So for this guy, such that what this loan that is taking, let's assume maybe we'll be giving this person 3 months or 6 months, or depends, right? We need to build that in the model. So let me bring that here, and let's call this our loan period. How many months can we give, at least on average, can we give to someone taking a loan on our platform? How many?
6 months.
6 months. Okay, so let's say max of 6 months, right? 6 months. Okay, so that's good. Let's leave that as 6 months. So but before we do that, let's even calculate our savings, what we'll be making from our savings. So interest on savings, so which is more like a cost, but for now let's just put it like this. All right, so that will be equal to average. So before we even do that, so I was expecting us to talk. We're supposed to build out our savings schedule. Right? So we're going to have our beginning balance. Let's add our new savings. So new savings. Then let's say some withdrawal. Then we have our ending balance. Right, so this is the way I want you to think. Yes, at times the inputs might be, you can have a model whereas the input is just like 10 worksheet, 10 rules, but the calculation will just be very, very big, right? Because it's all about the thinking, this and this. That's how I want you to think as a modeler. The truth is, you will not see anyone to teach you those kind of things, right? The thinking part of it. So new loans, so we are saying okay, so new savings, so we are saying this will be the new savings that will be coming in every period. Am I correct? Right, so equal to new loan plus new savings minus withdrawal. Remember, we also did not factor in withdrawal into this our model in our inputs yet. So let's create that. So let's say percent of withdrawal from savings. Right, so as I said, you can be creative, or as I said, finance is very, very flexible. It's not like a one-way thing. So let's say percent of our savings, maybe should we say 20%? Is that reasonable? So let's look at it from the calculation part first. So let me bring that in, equal to this 20%. So let's decide to keep that constant, should we? Okay, percent. So are we using savings per users or total savings for the total savings? are we using savings per users or total savings? Okay, exactly. That's a very good question. Oh, yes, that's true. Thank you for that. It should be our total savings, right? Total savings. Thank you for that.
Yes.
Yeah, so it should be our total savings. So let's draw that to the right. So which means at the end of the period, 33,719,000. Okay, that seems to be fair. Then let's say our withdrawal would be so previous year ending balance multiplied by this our percent of withdrawal. Right. So let me drag that to the right so that we kind of know that. Okay. So almost every month. So I think this withdrawal is way high. What do you think? It's way high. It's kind of way high because it's almost equating
At times even greater than new savings.
new savings. Okay. What do you guys
Yeah,
think?
so I think it's just 10% or 15%. Yeah.
Okay, so for now let's
check it.
Yes, we can always play with this, play around with this. Okay. So I think this is good. Okay. So which means this is our total savings. Now our interest on savings. So our interest on saving will be equal to average. So we are not using, so it will not be coming from the schedule, it will be from this. Okay, should it be from the total savings or it should be from this our savings schedule to calculate our interest on savings? What do you think?
I think it should be the maybe opening or closing balance on the schedule.
It should be the savings schedule, right? Okay, all right. So,
savings schedule. It should be the schedule.
Okay, perfect. I just want to be sure we are together with this. Okay, so average of previous year ending balance and current year ending balance, then multiply by what? Multiply by the rate. So what is our rate on savings? Customer savings, customer deposits. Right, enter, drag that to the right, and that is more like that. So this is more like a cost, but when we are building the interest income, we see that. So for our loans, we said we need to factor in this loan period. So which means this person that is taking loan today, this total loan will be repaid. We expect to receive this in the next 6 months. Right, so let's draw that repayments first. So before we draw the schedule part of it. So where's our currency? So let me link this to what we have here. So basically they are more like two approaches to financial model. So you might see some people when they build their model, they don't usually create assumption under each of these period like this, right? That is more like one method. Mostly kind of uses for things related to project finance. So you always have your assumption only for the base year. So everything will be in your inputs. Then they will now create different scenarios. So as we have this year 1, year 2, year 3, year 4, they will now use it to create maybe base scenario. All this assumption will be repeated for the base. Then the best case will be some set of assumption. Some worst case will be some set of assumptions, so that you know that just more like two methods. So that you have it year out like this, or you just create everything everything just come under your input. Then you can then create different scenario for that, right? But I usually prefer this, right, to be candid. Okay, so what formula do you think we can use such that this, whenever we have 6 period there, it just counts from 1, 2, 3, 4, 5, 6. So which means this 765 will be coming in our months in 6th month. What logic do you think we can use? Our Excel guru in the house. Let's think through it. It's all about thinking. It's all about thinking. I know some of us forgot to include this in our assignments. Index. Are you sure index will work? Razak, yes. Can you unmute your mic? Run me through. Right? How do you think we can make use of index? So let me even do something. Okay, yes, Razak.
Good morning, Victor.
Yes, good
morning, Victor. Okay, based on my understanding of what we did last weekend, that if we want to get some information between a period, So that's index. As that was when I was asking that, okay, when the standard said we don't need to add code, that's just my understanding. That based on what we did last week, that for us to get an information between some period that may fall in between some period as we are looking for.
Okay, I understand that. I understand that exactly. Yes, yes. Well, that's a good suggestion, but I'm not 100% sure if it will work. So this is what we want to do, right? You see this 765,000. We are saying if someone is getting this, right? This 8 users that we are giving this loan of this total 765. That means we are giving them 6 months period to repay this loan. So which means let's even assume it's more like a bullet debt, right? Where they will be paying all these things, we will be getting all the cash all at once, right? Let's leave the part of amortization. As I said, you can always be creative. Let's assume this whole cash, right? In our book, we are going to record it that we are getting everything back in this 6 months in June. So which means this 765 for this year one, year month 1, month 2, month 3, month 4, month 5, nothing will be coming in. So which means for this period will be blank. Then here everything will now start flowing in from here. So let's assume we are doing it manually. So which means this 76 will be coming in here. This guy that is coming in month 2 will be paid back in this period like that, right? You can do it manually, but remember, we are saying we are building a flexible model such that by the time we send it to our users, what if our users now say, no, it's 100k, 100k should just be for 3 months, that is way too small, and they change it to 3 months. Now look at what happened. Our model is still counting from 6, so which means we now need to come back again and start typing this. So you don't want to be doing that stress. It is a model, so it should be flexible. So I think the method we can use is offset. How many of us know of offset formula in Excel? Many of us know of offset in Excel. The funny thing about Excel is there's nothing you want to do in Excel that does not have a solution. Yes, that's the truth. Excel is so broad, right? So what does offset do? So equal to, so let me type here. So let me zoom out so that you see. Equal to offset. Now it will ask for a reference. So let's assume, so offset is more like you counting. So let me type it again. So offset, it returns a reference to a range that is giving number of rows and column. So let me assume. Someone said the offset they know is Cardi B husband. Okay. All right. Okay. So let's look at what offset does. So offset, let's assume it will first ask for a reference. So let's assume I have this my 100. And I want Excel to give me this 577012 as a result. So which means I want Excel to look at this my reference where I'm starting from, right? Count 1 2. I think that should be 1 2 by the column, right? And how many rows down? And like 1 2 rows down. So look at it. I have 100 here. And I want Excel to give me this 577012 as my result. So which means Excel will need to go column 1, column 2 to the right, then count how many rows down, 1 2 to give me this. So this is my start point, comma, how many rows, right? So let's say how many rows. So it should, let it even come down here. So 1 2, let me type 2, comma, then how many columns? So 1 2, it should go by the 2 again. So let me close the bracket and let's see what the result will be. Do you see that? Should I do it again? Should I do it again? Or you can we got it right?
Yes, take it away. Take it one more time, please.
Okay, all right. So this is what offset does. So offset, let's assume I put my, so for the offset, you can see a reference. It's asking for a reference. Let me pick where we have this 100. And the result of what I want is this 577012 that we have in our month 3. So which means if I'm to count, for me to move from here to here, that means how many rows down? So 1 2 from where I'm standing. So I need to go 2 rows down, right? Then 2 columns to the right. So equal to how many rows? 1, 2. 2 rows, comma, then how many column? It should go 1, 2 again, then I type 2. And then I close the bracket and press enter. Then you see what happens. It gives me this. So if I ask the column to move only by 1, it will give me what? It will give me the 659. Right? So it's more like family of indirect formula and the whole thing. So this is what we're going to use, but there's more now additional logic to that. So let's take a look at this. Let's take a look at this. Let's take a look at this for our repayments. So we are saying equal to offset this guy, comma, we don't need rows, so you should not move through any rows. We are not moving down, we are not moving up. We still want to maintain that same row, so I'll just represent that with another comma. Now for our columns, we want it to give us to start from 6th, but the 6th we want it to start from here, then 1 2 3 4 5 6, right? Count the 6, then from that 6 return it back to the first one which we have here, right? I want you to count from this guy which we are starting from. Count 1 2 3 4 5 6. So we are saying this 765 we want it to be paid in this June, but currently now you can see what we have in June is 429. This is not what we want. We want this same 765. So which means we want, immediately you get here, after you've counted 6, you should go back by the same 6th column count and give us what we have here. So I'm going to put that as, so let me minus, right, minus this our period, right? Let me close the bracket and press enter. So let me return this back to 6 and put this back to 6. So minus, so let me even put this minus, let me put it in brackets for now. Let me put it in brackets for now. Right? Or should I do that again? So equal to offset. It should start from here, comma. How many rows do we want? We don't need it to move through rows. Everything is on a straight row. Then for the columns, we just want it to give us minus this our what? Our reference number. Close the brackets and press enter. So let me even drag it to the right first, and let's see. Now take a look at this. See what's happening now. We want this to come in, so you can see this 765. Don't worry about this guy that is returning here now, because it's starting from here and it's going back like 6th row back. As I said, that's what we've set there. So sixth column from here will give us this naira sign. So that's why it's giving us that. There's a way we treat that. Don't worry. So you can see 765, and we said this, Victor. If you replace the row with 0, yes, it will still work. Yes, if you replace it with 0. So in Excel, both comma and 0, whenever you want to put, you are dealing with a function, which definitely give you the same thing. We always give you the same thing. Yes. So you can see 0 to give you the same thing. If you just put ordinary comma, to still give us the same thing. So now, which means here should come in June and not July. So which means we need to subtract 1 from this our period. So this is our period minus 1. Putting it in brackets, enter, drag it to the right, and we have this. So you can see definitely this is coming in our what? In our year, in our month 6. So yes, so this it's not like moratorium, as I said, it's more like the loan period time. So we are saying, oh, if you are giving you this 8 people that we've given this 100K, they'll be paying back within 6 month period, right? So let's assume it's just a bullet thing, right? They might be paying it small, but let's assume we are putting our account together, that this total money will be paid in this total period, right? Even though they might be splitting it over 6 months and all those things, but let's leave it like that. Let's leave it like that for now, right? So you can also be creative, as I said. If you decide to break it down, how they'll be paying this over 6 months, right? So you just break this by 6 months and goes like that. You can also do that. But for this one, let's assume the way we do our account is we assume this, we give it out now. We are collecting everything back fully in the next 6 months, right? Then I can just copy this for the period, and you can see just simple offset formula. So even if they decide that, oh, you know what, this way too much, let's put it back to 3 to be able to collect our cash, you see automatically it will just adjust itself automatically.
Sorry, Victor, one question, sir.
Okay.
I just want to be a clarification. If we say 6 months repayment period, starting from period 1, should that period 6 not elapse completely and we collect the the 7th period? Because I'm giving you have 6 months to repay me, so you have 6 months free, but by the 7th month the money must come to me. I'm asking just for knowledge.
No. So we are saying we are amortizing the. So when you are saying, so for example, you are taking a loan and the loan is saying is for a 5 years period. In your balance sheet at the 5th period, your balance supposed to be 0. It is the same concept. So we are saying, oh, this loan is for 6 months period. That means at the end of this 6th month, you are paying everything in full. So it does not span to 7 months. Do you get?
Okay.
Yes. So 6 months means this, at the end of the 6th month, you are paying everything in full. Not that 6 months, after 6 months, that's when you are. It's different from moratorium period. So it is moratorium period that they tell you that, oh, you have moratorium period of 2 years. So which means your repayment will start in year 3. But
clear. That's clear.
All right. So this is what we have, and you can see how simple this is. So even if they decide that, oh, no, we want to make it 4 years because of the offset, that is the magical thing. So how do we get repayment for loan that we're giving 6 months before the end of the month? How do we get repayment for loans that were giving months? So as I said, if you decide to be creative with it, as I said, you can go ahead where you're at. You are saying this will be divided by 6 and be paid over the 6 months period and everything. But this one we are assuming that yes, even though everything will be paid monthly, let's just assume in our own book of accounts we will be recognizing that the whole thing will be paid at the end of the period. Yes. I hope I got that question right. So let's 6 months and we have this. So now let's build our loan schedule. Loan schedule. How do we treat default? Yes. So yes, Oladipo, give us your insights. How do you think we should do it? As I said, this is also a learning curve for us, and it's not like a teacher to student thing. So let's rub mind. Yes, we need to factor in default as well. So should we call it default, or let's just call it provision for irrecoverable debts or impairments? Either one. What do you think? So what should we call it?
Okay. Good morning, Victor.
Yeah. Good morning.
Hello.
I can hear you.
Yeah. Okay. Okay. Yes. I was thinking we should give it maybe a percentage of the full amount, like maybe 5% or 10%, something like that.
Okay. All right. Our banking guys have given us suggestions. They said we should use our non-performing loan. Yes, non-performing loan, NPL. Yes, provision for LPL. So let's use that. And maybe so we might need to spread that over the years, right? Or should we make it constant? Okay, so it depends. So we can also decide to make it constant. So let's say, I think, what percent should we use? Any suggestion? Mikoyem, what percent do you think we can use? What percent do you think we can use for our non-performing loan? That is average non-performing loan of a bank. Okay, we can compare bank to, so start up there. 7.5. Okay, so suggested 7.5. So let's put that as well. So let's build our loan schedule. So we are saying beginning balance, right? We have addition. We are adding loan given. So let's say our loan portfolio or anyone, right? So we are deducting our repayment, and then we are deducting our provision for non-performing loan. Then we have ending balance. So this is one of the reasons why it is, in fact, is a must right? Okay, we should call it loan disburse. Okay, thank you for that. So this is why it is very good you have the understanding of the industry that you are building a model for. It's not all about the number. All right, you can really be messed up when you build a model. This is I'm talking from experience, right? You can really be messed up when you build a model, especially most from my local area clients, right? Because number one, they believe you are a magician. So once they, oh, can you present your model? Once there's a lap or there's a gap like this, they will really want to eat into you. But if you know about the business, you know about the industry and the whole thing, definitely that because when you are building your model must be able to answer almost every question. So you build this model and someone is asking, okay, so what do you think? What would be the provision for what would be the non-performing loan percent? And you forgot to factor that into your model. The next thing is how do you get to defend that on that spot, right? So those are the funny things. Is always way beyond the numbers. So that's one thing I want you to know. It must tie with the business strategy and the industry kind of activity. So beginning balance, closing balance for previous year. Our loan disbursed be this total loans here. Repayments equal to just the repayment here. Let's just factor this in for now, right? Then provision, so let me bring that percent in here, put it in percent. Let's also link that. So for the provision for loan will be should be previous year in the balance, right? So multiply by this as well. Could either use our beginning loan plus loan disbursed, but I think this will be fine. So we're saying beginning balance plus loan disbursed minus repayment, then minus our non-performing loan, and we have this. You can just copy this. Remember, always make sure your formulas are consistent. Build for year one, drag everything for the forecast period, and this is what we have. This is what we have. All right. So what next? What next? What next? Let's calculate our interest income. Okay, so we should calculate our interest income. So then we copy this, our currency, and that will be equal to average of closing previous year imbalance, current year ending balance, right? Then multiply by our loan rate. So our loan rate here is 5%. Then we have that. So now let's calculate our total interest income. So we need that will be our interest income that we have here. Then the one we charge on our savings, interest on savings, right? And that will give us our what? Our net interest or net interest income. I hope I'm correct. Okay, yes, V Joseph. Any question, contribution?
Yes, I have a question.
Please
Good morning.
Good morning. Go ahead.
The provision for non-performing loans. Yeah, so the 7.5. Yeah, I'm trying to understand, like, is that not too much considering the interest, or is it? I mean, is it on each loan for each customers, or the total loans we are giving for the period?
Definitely, it's always done on the total loans.
Okay, total loans for each user, or like the whole money, the money we are disbursing for the year.
So when we say
or for the period,
so that's why it is the total loans for the period.
Okay, thank you.
All right. Okay, so our gross interest income. Let's put this in our currency. So we're saying our interest income minus our interest on our savings, and that will give us our what? Our gross. Okay, it's supposed to be gross. So copy that to the right, and this is what we have. So you get to a period our interest on savings is more than what we are getting from our interest income. That's kind of crazy. Is that reality? Let's look at that's what our model is saying here. Okay, so what do you say? What do you say? Something strange is kind of happening here. This number Let me hear from our guys. Is this a normal thing?
No, it's not normal.
Okay, because
Interest expense is exceeding interest income in
yes,
some years. It's not normal.
which is not good, right? Okay, so someone is saying it's supposed to be net interest income. Either way, let's just call it interest. Anyone interest income. So the interest income minus interest expense is not that supposed to be the net. It's supposed to be net. Either way. You can either pick the one you want. Pick the one you want, but you should know that it's interest income. We are deducting our interest on savings. Okay. So something is strange is happening here, guys. Let's take a look at it. Interest on saving is more than interest on our interest income. What do you think is happening? Should we not make money from saving as well? So yes, so we are giving, so we have people depositing on our platform, and it is part of it. Okay, so I think we've actually missed out a connection here, right? We've missed out a connection here. Wait, I think we've missed out a connection somewhere here, because this is how it's supposed to work. As we said, the saving is actually driving the total loans that we can give out. Do you agree? Do you agree? The total savings
Yes.
supposed to drive the
Yes.
total loans that we give out.
Yeah.
Exactly. So now, because we are saying
That's the source of funds that we have.
exactly. So it's more like a bank, right? Because here now we are saying 10,000. So let's look at our calculations and let's look at the savings. So we are saying 1758. We have 1758 savings, right? And here we are saying we are giving out loans of 765. The next question is, where is the fund coming from? Right? Where is this 765? Where is it coming from? So so as I said, remember I told us that we are going to do some mistakes. I will make it very, very practical, as if you are building your own model, right? If you go online and you are doing a course, they've already factored in everything kind of looks perfect, right? Then when you get to the reality of it, you now realize that this thing seems not to be the same. And that's one thing I want us to learn from this our boot camp. So you can see now that definitely we made a mistake. All right, we forgot to actually point that out, and that is one thing that makes you a very good and great modeler. When there's a mistake, you should be able to see it, right? Excel does not make mistake. That's the truth. It's more like a garbage in, garbage out. So what do you think we need to do? What do you think we need to do? We need to do something.
Yeah, we need to restrict the loan that we can give to the to probably to the amount of savings available, or a percentage of that.
Okay, thank you for that. Let me hear from someone else. What do you think? What do you think? What do you think? Let's rub mind. Let's rub mind. Let's rub mind. Okay, say Abraham.
Yeah, I think we should make the saving the loan like the maximum loan we can give out as a percentage of the savings.
Okay, all right. Thank you for that. Let me hear from another one. And how do we get to do that? How do we get to do that? Right? Loan cannot be more than saving, exactly, unless we are saying maybe we have another source of funding. Maybe there's a fund separate somewhere that we'll be using to drive that, but I'm not sure this our model is capturing it that way. So what do you think we can do? What can we do? What can we do? What can we do? What can we do? So let's assume, let me come here. So under our loans, right? So let's make our loans. So yes, we can still leave this average. We are saying percent of savings. So okay, the loan should be a percent of savings. We can make an assumption for reserve. So as I said, financial modeling is problem solving, right? As you're thinking this, you're thinking that, you're thinking that, right? The first thing we are saying, okay, what if we have a loan savings coming flow straight into loans? But on the other side, what if we make assumption for reserve? What if we make assumption for reserve? Let's look at our use of fund. Do we even have any reserve from our use of fund? 39,500, and we are assuming this will be more like running the business for a certain period of time. So I'm not sure that's coming from here. So we can either make a reserve, but I think the best way for us to let's be realistic. Let's make the savings to flow into loans. Right. So let's create one. So let's say percent of loans from savings. I think should we make that 80%? Should we make that 80%? Is that good? Right, 80%. Okay, 90%. You remember we also need to make provision for people that we need to make provision for people that want to withdraw their own fund as well. So in fact, before we go far, let's look at percent. Let's look at percent of withdrawal to savings, because I think that will also give us some guidance. Right, so we're saying equal to current withdrawal divided by previous year day balance. So please correct me, correct if you are wrong. Remember, we are doing this together. It's not a teacher to student thing. So let me put this in percent. Right, drag this to the right, and okay, so this stands as 10%. Right, so which means let's make this, to be on the safer side, let's make this 85. Right, it's supposed to be 90, but let's be on the safer side, let's make it 85. So now, how do we now get to restrict this guy? How do you get to restrict this guy? What method do you think we can use? Right, as I said, most time when I'm building my model, I always make sure there's this transparency of a thing in my model build. So let's put this in percent and let's make it a link cell style. Right, so what we try to get is this, equal to 85% of our this 175. Okay, so in fact, I think because yes, we can use max, but I said we can make it easy, we can simplify it. So should we make this? So let's assume, okay, since we've already deducted our withdrawal from here, right, I think we can use our 90%. So let's use the 90%, because we've deducted that already. So we know that this is what we have available to give out in form of loans. Right, I hope we are getting the flow. We are getting the flow. Right, let's build that logic. Then now let's look at the maximum loan we can give. So maximum loans given, maximum loan disbursed. So this is what makes it a model. It's not about just saying this and you just close the everything. Step back, ask, does it make sense? If I'm presenting this model, they ask this question: can I be able to do this? Can I be able to do this? Can I be able to do that? So let's now use equal to mean of our total loans that we've calculated, comma, and this percent of our savings that we have in form of cash. Do you understand that? And close your bracket. Yes, I know some of us would have preferred to put everything inside one mean or max formulas, but I think standard is saying always break things down. So these are maximum loans that can be disbursed at this particular period. Drag that to the right, and you can see how this works. Right, so which means the total loan that we've calculated is definitely higher than this. Now, if there will be a reserve and the whole thing, which definitely additional funding or anything coming in from anywhere, we also come with its own cost. If need be, can always factor that in. But this one, let's make it like this. Then for our offsets will now be working on this maximum loan disbursed and not on the total loans anymore. Right? So we must tie together. Now for our loans, then the loan disbursed, we change that in our schedule. We then be what this maximum loan disbursed. So let's look at what's still happening. What is happening? Interest on savings. Let's look at interest on savings. So it looks like our interest on savings is a little bit high. Okay, 10%. Oh, wait, this is supposed to be per annum, right? Let's look at that. Is that what we gave to them? This is supposed to be per annum.
Yes, it should be per annum.
Exactly. So as I said, there are some few things that really matters as when you are building a model, right? You also make yourself a model auditor. There are some people that all they do is the audit model. They just look for that error and everything to put things together. So this is supposed to be a yearly percent. There's no savings you'll be doing that they'll be giving you 10% monthly. Is there any? Let's clarify that. Let's clarify that. What do you think? What do you think? What do you think? Please don't. We are talking about business. We are talking about business. Please, I'm talking about business. Okay, so Miko is saying the other thing is loan interest should be higher than sales. Definitely, because our loan interest, this is monthly. So by the time we convert this into monthly, this multiplied by 12, definitely this is around what? This is around, okay, this is way too high self. This is around 60%, but let's leave that for now. We can always come back. So our deposit, we are saying 10% per annum. So this is not yearly. So maybe we need to put that tag, annum or yearly, either one. So it's kind of obvious, right? It's kind of obvious. As a modeler, these are the things you should give attention to. So this 10% on our savings, that is way too high. That is way too high. So let's divide it. Do we have months in our model? Okay, so let me just bring one of our months here. So where's our month? Let me just link that here, because I'll link sales star. So then this 10 divided by this 12 months to make sense, right? So you can see modeling is not beans. Trust me on that. Trust me, there are some things that you might not get to learn if you take 10,000 courses, right? But courses are very good. Trust me on that. So this is what we have. This is what we have. And now let's see now. Let's all see what do we have. Okay, so I believe now it's making sense. So our interest income is a little bit higher than our savings. Does it make sense? Does it make sense? Look through. Do we still need to do any other adjustments? Do we still need to do other adjustments? Do we still need to do any other adjustments? Are we good? 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 Let's look closely. Let's look closely. Okay, J Brown.
Yeah, I think at the end the interest income is kind of high. Like, is it realistic
Okay.
at the end of our?
Yeah. So let's also look at the assumptions. So we are saying we'll be charging 5%. Can we find compounding interest for the savings? Okay, Daniel, can you clarify that more?
Okay, hello, Victor.
Okay, yes, Daniel.
Yeah, so I was just wondering, if you have a savings account or somebody is putting money into their savings, interest that is paid from the previous period will add to their savings, the actual amount that they saved, and then their savings will be growing over time. So interest in that sense will be compounding. So this year's interest or this month's interest will be based on the actual loan amount, the actual savings that you put in there, and then all the previous interest that you've already earned on your savings.
Okay, so I understand what you are saying. So which means more like a beginning balance than the addition just for it to compound, right? But the formula we've used here is average of previous year ending balance and current year ending balance. So I think that ought to have cater for that. So what do we think? Guys, let's think about that's the valid point. So he's saying typically, right, someone that you have a savings last month, then this savings this month as well, you have so it's supposed to be a compounding thing. So which means this 148 will be added to this 254. So which means for this month it will now be something like 354. Then it's to compound again for the next one. That's his own idea. But I'm saying also, since we've actually make use of average, since we make use of average and we've also factored in some withdrawal as well, do we think that will also work? Okay, yes, and F I'll do. I don't know. We cannot hear you from our end. Yes, I know you're trying to say something, but we cannot hear you. Maybe you need to check your audio, or better still make use of the chat box. All right, so our guys in the fintech industry, what do you think? Yes, since we've used average, yes, we have more like we've technically considered that the compounding thing, right? So I feel the average is better. Yes, I would have really loved to hear from audio as well. But maybe you can just type in the chat box. Yes, we cannot hear your audio. Maybe you need to check your audio connection from your laptop or something. What do you guys think? What do you guys think? Let's because that's a very good valid point, right? Because suppose it's definitely a compounding interest, but I think the average ought to have catered for that as well. What do you think, guys? What do you think? What do you think? Yes, yeah, right. This is a model, not really actual, but as much as possible, let's be realistic. Yes, let's be realistic. So number one, we don't really under forecast. Average is better, right? Because for you to enjoy the interest, also you must not withdraw for a particular period. That's a valid point. Thank you, F. I'll do right. It's saying average is better. Yes, yes. Average kind of smoothen things out. I agree. I agree. Yes. But that's a very good point. So that you also keep that at the back of your mind. So maybe you are building your model and the company is saying, okay, you know what, we'll be compounding it, right? There's always a condition attached to the interest on saving. Yes, I agree to that. So let's work with the average. Yes, but that's a very valid point for you to keep at the back of your mind. You can always compound the interest if that will be so. When you are having a discussion with your client, those are the questions you try to ask. So you really need the understanding of the industry. Now for our input, seems our loans, so we are saying this is monthly, so by the time we multiply 5 multiply by 12, that is way too high. 60%. Ha, what do you guys think? I think this 5% is way too much monthly. What do you think? What do you think?
That is a bit high,
Yes.
but interest rates from fintech too are high, especially if it's charged monthly. But I think 5% is a bit high, maybe 3 or 3.5%
It's too high. Yes,
will be fine.
let's say something like 2.5. And you know the fact that they are paying it monthly, uh the fact that it should not be a no, it should not be a reducing. Yes. Hmm, that's true, because remember the loan too are unsecured. That's true. That's true.
So,
Yeah, that's something
hello.
that okay.
Yes, Binga.
Sorry. Okay, yeah. I think initially when we started, that was one of the things we considered. I think someone mentioned a spread because
Yeah.
the fintech company also needs to have a spread because sometimes they too, like we said, the loan is unsecured and they might need to also get some things from somewhere to make the money available. They will pay interest to the guys that are also saving the money they are offering you as loan and things like that. But like a lady said, I think probably 5% is too high.
Yeah.
It's on the high side.
The high side. It's on the high side. Yes, right. Because fintech, you're also giving them number one unsecured loan, right? And you're also giving them that accessibility. Because if they will be
I
getting it
think we
at this
should do
percent,
3%.
they would have just gone. They would have gone to bank to collect the same loan. So you also want to
I
Please,
make
think we
it.
should do 3%. Because even the secured one, the salary advance by all these banks is usually 1.5. So I think 3% is justified.
Okay, Remoni charges 4% per. Okay, so let's make it. I think 3 is fine. Let's keep it at 3. 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 But the fact that number one, it is unsecure, the accessibility is the kind of make it very easy for you and all those things. So that's fine. That's fine. Salary is a secured loan, but they can actually sack someone from work and.
So yeah, that's what I mean. That salary is secured and it's 1.5. So 3% is justified
Okay.
for unsecured.
Okay. All right. So I think this is fine. 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 At least this still makes sense a little bit. This still makes sense a little bit. So sorry for some of us that we are outside the country. Yes, we are using our currency. So maybe after this, maybe we can have a session where I will teach us how you can build like 2 or 3 different currency in your model. and all they will need to, you have one small button like this, and they just, oh, I want to see it in naira, I want to see the model in dollars, I want to see it in pounds, and they just click on the button, the whole figures just change, and all those funny things. Okay, all right. So this is our interest income. Then which other thing do we need? So then our investment facility. So our investment facility, I think that should be a little bit straightforward, right? So investment. So let me try and put a shape on this, so that kind of, by the time we are looking for it, we know that this is where we have it, our interest income. So at least, maybe some said gross, some said net. Anyone, at least, just so you can use either net or gross. Just select the one you want. Select the one you prefer. Okay, so the next one is our what? Let's deal with our investment facility, and I feel that should be a little bit straightforward. So we're saying our average investments per month, right? So let me work a little bit lazy. Let me go and look for a formula. Okay, and I paste that here. So what do we need? That is on 105. 105. 105. So let's also see, I hope we considered insurance as part of our cost. So maybe we're going to put that as part of our, let me see if we include it in our insurance. Okay, we've included it already. So in our operating expenses could also form part of our okay, since we've also made provision for non-performing loans, so I think that's supposed to cater for it. Okay, so average loans, then our investment growth. Okay, we already have that. So what is our rate? What is our rate on our investment facility? So this should be in percent, and also linked self-start. Then our income from investment facility. So let's also make that an average of previous year, current year, multiplied by the rate. Just to keep things simple, right? So to get our total revenue will be our net or gross interest income. So let's let's work with net interest for this one. Then the next one will be income from Victor. Isn't the investment facility 1.5? Is that 1.5? I think that should be monthly. Yearly will be okay. Yearly. That not way too small? What do you think? Is that not too small to be
Not really. Is that not management fee?
management fee? Yes.
Is that not the normal management fee they charge in asset management? I think 2% is what traditional asset managers usually charge.
Per annum, right?
Yeah, yes.
Okay.
So I think 2% is fair.
Okay, so let's just
Per annum.
divide that by 12 then. Let's go back to our assumptions. Let's divide this divided by our 12. Okay, this is small, but you can always make an extra adjustment. So let's have this, and we have our total revenue. Okay, so a lot of things are really happening in the fintech industry, especially for those in the part of the part of it. It is what it is. So let's calculate our direct cost. So we've done our revenue. So let's call it our direct costs. For our direct costs, we're going to have our what? Our processing fee, hosting, and our other costs. Right. So let's use our lookup formula to bring everything down. So this should be row 109. This is the most important part of it, and you only have just two parts, right? Your inputs and this your calculation, and the calculation is the, I think, is very very important, because once you get once your calculation is wrong, trust me, you've already messed the model up. So for our processing fee, so we are saying that should be more like a percent. So processing fee should be 2% of our total revenue, right? Yes, our monthly revenue kind of look low, but it's expected. It's not, and that's the truth. That's the reality of it. That's the reality of it. But don't worry, we can always make necessary adjustments. So that one is a small thing. So our hosting will be, that will be constant. Then our other costs, saying that should be. So don't worry about the monthly thing being look the monthly part looks low. It's expected. That's what I think. That's even the reality of it. You don't expect to start a business today. In fact, if you have to be the reality of it, I just don't want to make it too big, right? I don't want the model to be very very big kind of thing. We're supposed to factor in some project finance infuse, right? And what that means is we factor in some timing. So maybe the first 3 months the business is not even making anything, but most times for startup, just keep things straight. uh, is inside project finance that we do that a lot.
Victor,
Yes, Daniel.
yes, please, can I see the formula for the processing fee and then the other costs?
Yeah, so the process fee, we just said the percent of our total revenue, total income. Yes, and the same thing.
Okay, then the other cost.
Yes, that's percent of our total income as well.
It's also okay. Okay, thank you.
Yes, just to keep things simple. Just to keep things simple. All right, so you can see it's really great. Right, that's what we can say. So now let's look at our salaries. So for this for the revenue being slow, I think this shows the reality of it, right? Because during this maybe the first 6 months, you are even struggling to get users on your platform, getting money and the whole thing, and you can't just be giving money out to anyhow people won't just come and start saving on your account, on your platform, without having that trustworthiness. And that's why you just see some businesses need to go and get some celebrity, so that they can they just give that trustworthiness part of it, right? Because you cannot just create a platform and you come and meet me and tell me to come and start service. I don't know you. Right? Your business has not been in existence, so maybe the first 6 months you are trying to do branding, marketing, making sure that yes, this that, building that branding part of it. So let's go ahead with our salaries. Let's go straight into our salaries, right? So as I said, yes, I know many of us would have preferred, okay, let's create revenue calculation somewhere separate, this type of calculation separate, this one separate in different worksheets, right? Our standard is saying you really don't need to do that, right? Standard is saying you can let everything still be in one worksheet, then try and use outline. So let me show example, a good example of that. And if you notice my own model, I usually collapse the first 3 columns, and the whole objective is to be able to build that outline. So let me build a sample outline from my general assumption. I will highlight it down to the second headings. Before the next headings, I'll go to my data tab. I will see this group guy and I'll click on group, and it's going to ask me, do I want to group rows or column? I want to group rows, and I'll click on OK. Now it will display this number 1 and number 2 at the edge of my Excel. So maybe you've seen some Excel file having this. That means it's telling you it is outline. So which means which means if I click on my one, look at what happened. It collapsed everything that I have under this my general. If I do the same thing for my financing before the next one, right? Click that, click on my one again. You see that it collapsed everything that I have under here. If I do it for my business operation down, so it just kind of collapsed everything that I have under that. So it's more like a section. Your model kind of read like a book, right? So you just kind of see everything like this. So any part you want to see, maybe I just want to go to my business operation, I don't want to see others, you can. It's very, very easy to see, right? So most times you can create as many. So let's say under this one, let's create for the second one as well. Enter. So you can also use a shortcut. Let's reload the headings, and before the next headings, and press your shift alt right arrow, enter. So you can see it will add another one, so which means it's kind of read like a textbook. Let me do it for others so that you see how that just kind of make your model look professional. You don't have to be creating different multiple worksheets here and there, right? Make sure you break everything and make sure there is a good flow. Once you have that, right, your model just kind of flow as if you are telling a story. Then for your user to go through it, it will not be that difficult. So you just create this, and the model just kind of read like a book. So you can see this, you can see your model. So yes, this our developer. It's not in Excel, so that's why it's shown like this, and it's just easy for someone to understand. What you read like a book. So general assumptions, under general you have some macro. If you want to see only the macro assumption part, just click on this plus sign, and it just open up only this part, and the other part just kind of closed. Do we like it? Does it make sense? What do you think? What do you think, guys? Does this make sense? So instead of having multiple worksheets, standard is saying no, anything related to input should be in only one worksheet like this. So you can now use this outline just to group things together, right? You can also do the same thing for our calculation worksheet, and so it's just make the navigation easy. If they want to see only thing you've put under your user's assumption, they can click here, and they just see only the assumption part of your user. So you don't have to have multiple worksheets. It's really not professional, right? And because you don't want to make your Excel heavy, because you can build some model, especially when it comes to project finance model, where you have to build a lot of things. So in order not to make your Excel too heavy, just keep things short like this, and just kind of read like textbook. So that's and they can open everything all at once by clicking on the 3. All right, so salaries. Let's work a little bit faster. So assumptions link. I think we've done the most important part of it, assumption link, which is the revenue. So on the part of our assumptions, we need our here. So good. Now let's come back to our inputs under this inflation rate. Remember, we converted our inflation into a month-on-month period. Okay, so Razak is saying, I don't think we have incorporated default rates into our loan. Razak. Well, did you go out? So this is what we call our loan provision, non-performing loan, provision for non-performing loan. Yes, it's the same thing. So remember, in our guide, you have a part called model audit. So those are the things you need to put in your model audit. So non-performing loan, and you can add more like represent loan default. So you can always put this in your, those are the things that you need to put in your model glossary and model audit to avoid unnecessary question. So I hope you've seen that. So assumption list. So we said we should go back to our inputs. Here we have our respective rate. Right. So don't worry, I'll share the Excel file with us. So just to mention this, the last session recording that was shared with us, that was uploaded on my channel, yes, someone actually sponsored it. Someone had to call in, and the person paid for the subscription and the conversion. Right? Yes, even though the person said we should not mention his name, but that the person was the one that sponsored the video sharing of the last two sessions, right? Yes, as I said, everything is free. So okay, right. So here we have, and we've converted it into monthly rates. Now look at what the effect will be on our monthly multiple, right? Okay. Shegun is saying we are very grateful, Daniel Mensah. Okay, what did Daniel Mensah, what did he do? So we can all say thank you together. Shegun.
But the rest are paid for the video now.
No, I'm not sure. I'm not sure. I'm not sure. I'm not sure.
I'm joking. No,
I'm
I'm
not sure.
joking.
So, okay, maybe you could pay for the next one. All right. So this inflation rate, let's look at what this is actually saying, right? So that we know that we need to make another adjustment here. We divided this 13.25 by 12. And what we are saying is, I did not get it. Yes, you have it on my YouTube channel. You have it on my YouTube channel. The last two sessions. Yes, you have the video on my YouTube channel. Yeah, someone sponsored the first one. There's another person sponsored the second one. All right, so you can just check my YouTube or go to my LinkedIn status. Yes, I also put the link there as well, so you can see it from my LinkedIn status directly. Okay, so this inflation is saying 1.1, 0.9, and we change that into our multiple. So what this means is this. Let's assume we have 100 here, right? We are saying this 100 multiplied by, so let me zoom out very well. So we are saying this 100 multiplied by this 0.08 multiple, and look at what happened. This is not what's supposed to be, right? And the whole thing is coming from we dividing this guy by 12, which converted to this, and we now use the multiple to get this. Now, to now make that adjustment, to make the adjustment, we need to, instead of dividing this by 12, what we're going to do is this, right? Most time when there's increase in inflation, at times the effect usually comes in like quarterly. Do we agree? Whenever there's an increase in inflation, the effect usually comes in more on quarterly basis and not on monthly basis. What do you think about that? Do you think that is reasonable? So what that means is, instead of we dividing this by 12, we divide it by 4. And we are doing that on the basis of yes, most times inflation effect usually comes in quarterly basis. What do you think? Do you think we can use that? Right? And secondly, yes, the data most times usually collected quarterly. Government usually give us the reports on quarterly basis and all those things. Do you think that will make sense for us to use? So instead of dividing this inflation rates on monthly basis, what do you think? Let's reason it together. As I said, it's all about common sense, and you having at least a concrete backup reason as to why you've done it that way. Inflation is usually monthly. Yes, I agree with you. We are not saying inflation is not monthly. Inflation is monthly, but we are saying the effect of inflation, right, most times usually reflects on quarterly basis. And most time the inflation data, right, effect is also collected on quarterly basis. Do you think that will make sense for us to use? So instead of dividing this 13.25 on monthly basis, yes, I know, since we are doing the calculation, but now look at the effect. Look at the effect of what I'm saying. We have 100 here, and by the time we are multiplying it by this multiple, look at what is converting it into. Right? And secondly, remember, it's not as if the inflation will be changing like month on month. So we are saying, no, this year we assume for this month this will be the increase. The next year this will be another increase. So for this one, let's make use of the quarterly effect. So let's just put this as 4. So I think it is 4. We have 4 in the period. So instead of dividing this by 12, let's divide it by our quarter. Right? So let me delete this. Okay.
So Victor, sir,
Okay, yes.
just a suggestion. Maybe we want to leave the monthly inflation, then also insert the quarter just for view. But we know we are making use of the quarterly effects, but we should leave the monthly.
Okay. I got that. All right, so let's change this our calculations. Right, this was focused on the monthly parts. So let's make the necessary adjustments. So 1 divided by quarter. Okay, all right. So let's bring in our inflation. Let's bring in our inflation part of it. So this is our applied inflation rate. And bring that, so let me go and copy this our formula here. We're saying that will be row 19. So 19. Change this to 19. And put this in our multiple. And we have that. Right. So number 1, we need our salaries. So let's go back straight to our salaries part. Okay, so I'm trying to look at something from this our inflation part. Okay, all right. We can always make that adjustment later. So let's go straight to our.
Hello, Victor. Sorry, please. For that monthly inflation multiple, can you just state it there so that we know that it's quarterly?
Okay.
So that we don't get confused when we're going through the file.
Okay, all right. I'm coming to file. Let's see. I think we still need to make another adjustment here. All right. So I think this is what ought to be. Okay. So this 1.6 and this one. So we are using the 1 for this. So we make it inflation, and we said adjusted for quarter. Quarterly period. Okay, all right. So for our salary schedule, let's look at our salary schedule. So because I love at least my model to be very transparent, let's bring everything here. Let's bring it down, just for that transparency's sake. Right. Row 26 input should be changed to quarterly. Row 26 in the input. Okay. Mikoyam.
He meant to say 20.
Yes, we're 20, sorry.
Okay.
Thank you.
Okay. All right, so modeling is very interesting, and I'm quite sure you are seeing that from here, right? And the best way to learn it is it's just this is more like the best way. I won't lie to you, right? You can do a lot of courses here and there and there and there and there, but these few little things they matter the most, and that's what makes you a great modeler. So I think this is starting from 116. So 116. 116. Okay, I think I've changed that. Let me change that. So 116, then 116, enter. Drag this down. And let me submit. So this boots vest no get CFO. Okay. So remember, they can always update that. They can always update that, right? CEO, CTO, maybe we should change the CEO. CEO can still be functioning as the COO. So maybe we should change the CFO. Some people are already fighting one job role. So they can always update that. They can always update that, right? So they can always update that. They don't have finance team. I think they don't have accountant. They can be outsourcing that. Yeah, sorry. Don't always say yeah. So okay, but that's true. That's true. Supposed to have a finance team because that's very important more than anything. Don't be paid. Sorry. They have engineers, and that's the truth of it, right? Most of them don't usually. Okay, I'm also an accountant. Most of them really they place more focused on the engineering, the software guys more than the finance guys, right? Yes, and that's one of the things that's really killing most of them. And then they go and hire one funny accountant that will just be lying on their financial statements, won't know how to post correctly and all those things. It's just funny. So where can we put our let's put rest. Let's put where can we so let's say analysts and accountants. Okay. Let's put this finance and finance and analysts. Maybe so sorry our guys. Sorry. So maybe we should make them let's maybe three guys. Mhm. Sorry guys. All right, so let's bring the respective amounts, their respective amounts, salary pay per month. Mhm. I'm also an accountant. Yes, I don't know. Maybe that's one of the reasons why actually I had to run from being an accountant. Yes, they don't usually rate us. I don't know what we've done for them in this world. Don't usually rate us. That's why I just have to dust my shoes and let's go straight to finance. Let's go straight to our financial modeling. All right, so let's also link this. Let's link this. Let's link this. So there are a lot of those businesses now, right? They really don't have the true picture of what is really happening in their business. I won't lie to you. You don't you might not know, all right, until when you are building a model for a company that's more of a startup, but they've been in operation for a quite period of time. Then you will just see how funny their financials are, and especially for some of them that cannot even pay for external auditors. So it's what it is, right? You take a look at the accounts, and you cannot just connect this and that and here and there. Okay, so let me sum everything together. So let's be sure everything is correct. Okay, so we've multiplied everything by the inflation multiple, and I think this is good. This is good. So for the other operating expenses, so let's create for other operating expenses. So our operating expenses, so let me type that again. Okay, yes.
For the salaries,
Oh,
I think we forgot to
yes.
multiply by the staff count.
Thank you for that. So let's multiply by the what? Multiply by the staff head count. Thank you for that. It's very easy to know people that did the assignment from this. I hope I'm right. Yes, so many of us did not do the assignment this time. Okay, okay. So let's go straight to our operating expenses. Operating expenses. So I think that's all we have that part. So let me copy this currency. Let's put that here. So let me copy one of these our formula here. So let me delete this other one. So what do we have there for our rent? So starting at 147. If I'm correct. Yes, 147. 147. Please, I always advise and encourage us, make sure you get to do this on your own. It's always easy to look at the way I'm doing it and everything seems a little bit smooth. No, it's not always like that. It's not always like that, please. So operating expenses, when you do it yourself, the more you build, right, the more you get better at it. So okay, in fact, okay, Luashe is even telling us something. Rent and insurance, we always have like contract cost for the first month, right? But let's still keep things. Let's keep it like this. Let's keep it like this. There are a lot of things that can always come in, but let's just keep it like this for now. So let's get our total SG and A. Our SG and A. SG and A. So more like our selling, general, and admin expenses. Come to my audits. My guide as I'm under my audit, SG and A. So selling, general, and admin expenses. And also you definitely need to up your Excel skill as well, right? You can have a model that's kind of huge, lot of data, you have to model everything out. You really want to be fast at it, so it's always be good for us. So the first one, what are our pre-operating expenses? Pre-operating costs. Our pre-operating expenses. So let's scroll up to our use of funds. So under our use of funds categorization, right? So registration and licensing, I think we form part of our pre-operating costs, right? This awareness we also forms part of our operating costs. Do we agree? Do we agree? Registration,
Yes.
we cannot capitalize registration. Awareness, we cannot capitalize that as well. So these other operations and prepaid, we assume that will be that we've already listed that in our operating expenses. So registration and awareness, I'll copy it to form part of our, okay. So let me just sum it together. Come down here, then put our currency unit equal to, then let me scroll up so we have my use of funds. So my registration plus my awareness, that form part of our pre-operating expenses. Then our salaries. Our salaries, link that here, and our admin and selling expenses. So this will be our SG and A. So equal to, and also always remember, as a modeler, you must know your model. Please, it's very, very important. You must know almost where everything is in your model. That's why structuring is very important. That transparency. Keep it simple. Keep it simple. Create some logic. Let there be a flow, right? I think last week I had to go and present a model I built last year, like early last year. In fact, you know how many models I've built after that. But because the flow and everything was in the model, so it's easy for me to just go ahead with the presentation. So as a model, those are the things you need to keep at the back of our mind. So let's do our operating working capital. Operating working capital. So what do we have in our assumptions for that? So we have our receivables. So let's call this our current. Okay, so let's link the assumptions. Assumptions linked. So receivable days, prepayments, payable days. So let's use our formula. Let me copy this formula. So that's row 158. Then we have this, right? So let's link our revenue. I think we need our revenue, total revenue. We need our direct costs, and then we need our SG and A. Make this currency. So I'll just copy this, copy and paste it here. And we kind of have the same structure. I hope you are seeing what I'm saying.
Hello, Victor. Sorry, sir. Please, if you go to the formula, maybe K235.
K235. Okay.
K.
Oh, okay.
The K180. What are we multiplying there?
It's supposed not to be there.
Thank you.
It's supposed not to be there. Okay, perfect. Thank you for that. So I hope you can see what I'm actually seeing from here. I hope we can see what I'm seeing. I hope you can see what I'm seeing already. I hope you can see what I'm seeing. Right? The triangle shape, exactly. I hope you can see what I'm seeing. You can see what I'm seeing, right? This is crazy, but you know what? Let's go ahead first. Let's go ahead. Let's let's go ahead. It is what it is, right? So current assets. Let's go ahead. We'll come back to that. So I think we need one more thing. Yes, it's a normal thing for startup, exactly when you are starting your business. So don't be like all those models that usually kill business owners, where they'll be telling them your first 6 months you're already in money. Right? Many startups, they are still struggling to even break even after 5 years. So we should remove, there's no magic anywhere. So don't worry, we're still going to see that. We're still going to see that. So for our receivables will be what? Our receivable days divided by the days in the period. Then multiply by what? So this multiply by our revenue. Then for the prepayments, so prepayments will be on our some operating expenses being prepaid. So this is where you see the cash management thing comes into play. So total current assets just sum both of them together. And then for the current liabilities, so we have our accrual, payable, and okay, so these two. So that will be equal to payable days divided by days in a period, then multiply by direct costs, some of our costs. Then for the other one, others and prepaid expenses, copy that to the right. So let me just copy this formula. Let me put it here. Call this total liabilities, total current liabilities. I hope I'm not too fast. Yes, I know I can be very, very fast when I'm using Excel. I don't know why. All right, so for our operating working capital, that will be our what? That will be our total. That will be our current assets minus our current liabilities. Then we have this, right?
I don't think that should be payable days. It should be payables and also receivables.
Okay, so let me change them. I was trying to receivables, prepayments, this payables. Okay, thank you for that. All right, so our change in operating working capital would then be what? Would then be previous year ending balance minus current year ending balance, and that will give us our what? Our change in operating working capital. And yes, congratulations, we are through with the calculation worksheet. Let me also build that our outline inside is our calculation as well, so everything kind of look good.
Victor, please, what command did you use to bring up the rows and column again?
So I said shift alt right arrow enter, but you must have highlighted the range that you want to group
thank
already.
you.
Yes, highlight the range, then shift alt right arrow. You have that.
Okay.
Okay, so can just make it read like a textbook. So everything that we've done, can collapse it, and you want to see there, you can always go to any part of it. I've built one model and I created it like this. I sent it to the client. The client had to call me that, but Victor, I can't see anything in your model. I was like, oh, okay, you need to open up your model so that you can see what is inside the model. All right, so we are through with the calculations. We are through with the calculation. Now, how was it? How was it, guys? Ibrahim said, "Oh, this calculation choco." So how was this? How was it? How was it? How was it? How was it? Have you experienced something like this before, where you need to build your monthly model like this? And the truth is this: with this, we are like 70% done with our model, right? As I said, practice. The more you practice, the more you build, the more you get used to it. So when you build your model, you have you keep doing it over, so right? The more you build, then you see that, oh, make a mistake, you get to do that. But monthly model is always good, and you can always build out the trend. There are some models that are kind of seasonality. Yes, seasonality, where we build in seasonality into it, right? I think I did one for one loan company, one loan startup like that, right? And in fact, I had to build in seasonality. What do I mean by that? So let me take us, for example, to this revenue. So we are not teaching us that. So maybe that will be part of the additional package that will come in later. So what we are saying is this. We are saying total savings. So we factor that into people's savings, right? One thing is this, right? We are saying, oh, will be the total savings for month, and the other thing, we now factor in that seasonality. We are saying, oh, at the beginning of the year, people usually people don't save much at the beginning of the year, because you've gone to December, you've spent a lot. January, everybody is trying to survive and do things. So which means first month savings is always low. In fact, the second month is always low. Then maybe in the third month things can start, but when it's getting to around month 5 or 6, then people tend to save more, because you already start planning. Oh, I need to achieve this, I need to get this done, I need to do this, I need to start saving my rent, my stuff, need to meet some bills, and the whole thing, December is coming. So savings is always high during that period, right? As I said, that's one of the things that is really lacking in most of these our startup businesses. They really don't have that account. Most of them don't have a sound view into their numbers, and the data analysts kind of do a lot of work, right? Collect the data, try to analyze, look inside, and be able to make that kind of decision. So you know that, oh, during this period, this and this, during this period, this and that. So factor in, then we know that by the time it's coming to October, November, right? People start collecting money. People withdraw a whole lot during that period. They need to get the project done. They need to do this, finish up their projects here and there and there. Then December comes into play. Definitely November, December is as good as January and February, right? So you just factor in that seasonality. So you just create some percent. So January might be 50% of the savings you forecasted. February maybe 50%. Then March can increase by 55%. Then you're getting to June, you're saying 100%. You're saying 100%, 100%, and it's just slope downward like that. So that's what we call seasonality. They are bidding for some of these our supermarket as well. You need to factor in that seasonality, right? Whenever there's this festive period, people tend to make higher sales, right? Come to December, everything just high. Then comes to January, just kind of slow down a little bit. So that's what we call seasonality. Yes, we are not doing that one here, right? Maybe if you want to learn that, might come with might be on its own. Okay, so it's been a great thing, and just to remind us that we will really appreciate if you could go on our LinkedIn status and be able to post one or two things that you've been able to learn so far. So good. Yes, please, that is more like what you can actually use in paying for this great resource, right, that I'm really sharing with us. I really appreciate that. But let me ask you, let's assume you want to take this course, right, with everything you've done. How much do you think this is worth, or how much will you be willing to pay? So you can put it in dollar, you can put it in naira, you can put it in your own local currency. How much will you be willing to pay? At least from everything we've done so far. Let's say $500, nothing less than $150. Okay, how much is $150? How much would you be willing to pay? How much would you be willing to pay? Some are saying 80k, 500k. Okay. Okay, all right. So just to bust our brain, right? And remember, I'm also a Microsoft MVP, right? In my own local currency, to be candid, if I want to take you on this, if I want to take you on this, I'm definitely not charging anything less than 200,000 naira, which is my local currency, right? So 200k to dollars, right? How much would that be? So that's the truth. I won't lie to you. I prefer number one, I prefer not to teach it, not to teach you if you can't afford it, or I just do it for free like this. All right. So let's kind of, at least let's value what we have. So assume I've actually collected like so if let me even say I've collected to 200k from every one of us. You know, I should just go and buy one big Benz, right? But yes, that's it. So yes, we have this, we have this, we have this, we have this. Then let's go straight and create our monthly model. Let's call this our financial okay, our financial statements. Okay, so let me close up this my Excel so everything ends here. Close everything here. So for our financial statements, and the truth is this, I won't lie to you. I don't know. Maybe if you see it, you can let me know. Any course that you see online that's more like this, yes, please. In case you see anyone, I will love to see it as well, so that maybe I can recommend it for people that also want to learn and there's really no that time. So let's start. So the first one will be our what? Our net interest. So let me call this revenue. Let's call it a net. Okay, so let's bring two of them together. So net interest income, then this, right? So we want to build our monthly financial statement. I'll call this. So let's call this net interest income. So copy this, Okay, I'll just put it as currency. Then I can copy this guy, put it here, then this minus this. So we have this. Then the next thing is our direct cost. So let me be doing some presentation things to make it look good. Okay, so the next one is our direct costs. Then let me link that. Copy the currency. So all we are just doing now is linking. In fact, the cost of maintaining the platform itself is what it is, right? But those are the things that will give us guidance into making necessary adjustment that we need to make. So we call this our. So let's summarize the model, right? So our SGN here, just link that to what we have. If you want to list out the expenses, you can as well do that. Okay, but let's do it like this. Let's just link the summary. Pre-operating salaries. We can also make use of the total. So let me copy this guy format here, put it here. I'm just trying to work smart. Put the currency. Then this copy, put it here. Since my model kind of have the same structure. Sum it together. We have that here. Open this up. So the expenses is way higher than the revenue. Okay, it is what it is. So then let's have our EBITDA. Copy this format and put it here. EBITDA equal to. Okay, so we forgot to do something. You guys did not talk. So where's our gross profit? So that's our net income revenue minus our what? So we have this. So gross profits minus our SG&A. So let me ask us, what will you advise? What will you advise? What will you advise for this kind of business that is looking like this? What are the necessary adjustments that you think we can do? And that's where the next work comes into play. So when you see the model looking like this for the true 5 years, right? Number one, it's very obvious that the cost is way higher than the income that they can be generating. So now let's now have that discussion. So let's go straight to you being a business advisor, right, and strategy development manager. So give us your insights, give us your advice. What do you think we can do to make this model make sense? Because number one, the need to it's kind of obvious that the business kind of have a viability, right? Then the next thing is, what do you think we can do to make this make sense? Even if for the first 2 or 3 years is losses, yes, that is understandable. And remember, they need to get this funding. They've paid you already. The client have paid you. They've gone ahead to do their business plan. They believe everything is fine. So here you are building the model and you are saying this. Definitely you need to make some adjustments to make the model make sense. so that they'll be able to raise the fund because they've paid you. That's why they've paid you as a modeler. Okay, so what is the total customer at the end of year 5? Okay, I'm not sure we'll be able to answer that now, but okay, I think let's build everything out first so that we'll be able to answer some of the questions. All right, we can look through. So let's have depreciation here. So that by that time we can look at everything. So where's our depreciation? Depreciation. That is our depreciation. Then we have our EBIT. Let me copy this format. Let's call this our EBIT. Okay. So, okay. So this will be equal to our, okay, what happened? EBIT. No, we need EBIT. What's happening? Excel, don't act up. Okay, good. So equal to EBITDA minus depreciation. So we can also be thinking through what do you think they need to do, what do you think we can do. But a very good question. Let's see the users and that kind of thing. So interest expense. Interest expense. Then let's look at our interest expense here.
Hello, Victor. Sorry, I just noted something now. I don't think the company would be incurring pre-operating expenses on a monthly basis.
Okay. Why is that? Why do you think they won't be incurring expenses on monthly basis?
As I'm seeing pre-operating expenses there, as I'm seeing it on a monthly basis where we have from month 1 to month 12.
So
that pre-operating expense is a combination of 2 items. We have 2 items now. So it is the second item that continued after month 1, I presume.
I think Razak missed out when we were building this first part of the calculations. Alright, because I think we kind of dealt with that during our explanation. So maybe you need to go.
Awareness continued. Yeah, publicity, which is awareness.
So where we discussed that some of the expenses, right, might be an expenses that will spread over the 12 months period. Some might be the one you just incur at the starts each thing, and they just said, okay, let's assume the awareness is more like a budget of the 12 months that they'll be spending over time. They're still making provision for marketing in their normal operational expenses. So that's why you have it splitted into 12 months. So the next one, so you can revisit the video recording as well. So our profits before tax. So let me copy this format. Let me put it here. Okay. So equal to earnings before minus interest expense. Then we have this. We have our what? Then we have our provision for tax. So let me copy this here. Got this provision for tax. So we can decide to, okay, please, what constitutes the pre-operating expenses, because license fee should be amortized for the Olakunle. Okay, are you sure you are still with us? Because when we are creating our SG&A, that was the discussion we had on which line item to expense and which one to capitalize. That's what forms our SG&A. That's what forms our pre-operating expenses. So we went to look at our use of funds breakdown summary. We're saying that registration and licensing cannot be capitalized, so we're expensing it. Awareness, which is more like marketing, business awareness for the first 12 months, That's what we have. So those are the two things we sum together. Operations and prepaid expenses, more like provision for cash to use in running the business operation. And that's what we have here. Alright, so for the provision for tax, at times, yes, you can go ahead and build the old tax expense and the old thing. Pre-operational expenses are treated as assets. Miko Yems, I'm not sure about that. I say pre-operational expense.
That's it. That's how they treat it. Operational expenses are not expenses under operational expenses. Never.
Pre-operational expenses are treated as assets.
Yes, until you have a positive EBITDA or you net it off against share premium. These are the two ways you can take it out. Not through revenue.
Okay, let me get that. So we are saying registration and licensing should be capitalized until the business is profitable.
Yes, until you have a positive EBITDA or you have a share premium, then you write it off against share premium.
Okay, I'm lost. I'm not sure that's kind of work with my own accounting understanding. Just want to be sure. So you are saying a business will not expense and expenses they incur in year one until the business kind of have profits or business shows profit.
Positive, yes. If you call it pre-operational expenses, whether they are OPS or CapEx, you expense.
So just to be clear, right? We keep learning every day. Which of these, which of accounting concept or convention kind of itemize that, or is there a standard?
It is actually for tax purpose. It's not, sorry, it's actually for tax purpose. It's not a financial like IFRS standard.
Okay, so okay. So remember, we are not building a financial statement for IFRS, right? Financial model is not accounting, all right? Tax practice is different entirely. Even your normal accounting report should be your accounting, then tax they usually do their own. So almost every other profession kind of calculates what accountants what we do. Tax guys will do their own recalculation. We tell, oh, this can be exempted, this will be exempted, this is this. That's for tax purposes. So we are not building a financial statement for IFRS, and also for what we are not building for standard. Yes, I know we have your tax loss carried forward and everything, right? So you build that as well. We build that into model, but you are doing that by the time you are building out your valuation. That is where the usefulness of this tax, as I said, if you want to go ahead and build out your tax thing, you can do that. They are modeling for taxes and all those ones. But for now, we are working with our basic accounting understanding. We are not building a financial statement for tax purpose or for IFRS. No, we are building using our own basic accounting understanding. Saying pre-operational expenses should be expensed. So that's why we listed out the use of fund and we categorize them separately. Registration and licensing, you are paying that at the start of your business. You expense that. Awareness, the branding and the whole thing at the start, we are expensing that. Then tangible, we are capitalizing that. Operations and prepaid, that kind of flows into just a cash provision for the month-on-month running operation. So most times, please, I always advise you as well, and that's one of the things our standard is saying. Accuracy, right? Your model is not actual thing itself, right? Is we just trying to mirror what the future will be in order to have an informed decision making. So you don't have to don't overdo it, because the more you overdo it, the more you are being open to questions, right? I was doing a presentation to some finance manager of a thing, and they like, so can you tell us about the tax? What was the brain behind it? And I said, okay, you know what? So think about your user. As I said, it comes from different experiences. There's a time I usually build model and I put a lot of things. Then I get to the presentation. Then just one thing we just spoil the whole model. And just look as if you don't know what you are doing, right? So it was over experience you realize that, okay, you know what, there are some things that are really not necessary. So don't make your model be open to questions that can even spoil the whole thing. So, oh, what's the brain behind your tax? And I said, oh, as the name implies, provision for tax. So we trying to just give consideration about government in this business concept, and that's why we are saying, oh, let's make use of the typical corporate tax rate. Typical corporate tax rate. Now, this is a provision. By the time the business starts, number one, definitely if you are not making profit, you won't be paying taxes, right? That is subjected to the tax regulation. So definitely it's not something you can really model out. So it's just a provision. Let's make that provision, and we're using the 32% out. Whenever we have profit, let's pay this. Simple. Keep it simple. But whereas you are building everything, you are building tax forward, tax carried, this and that, capital allowance, initial, then you need to know that by the time you are doing your presentation, for people that don't know much about that, definitely you need to be able to explain everything. Then your model will now be a little bit messy. It's not as if what you've done is not correct, but now you are coming into irrelevancy of what is really not needed. The objective of the model is not for tax purposes. There are guys that's what they do. Model is only for tax purposes, and they face that. Right? But the whole objective of the model is not, oh, this tax you pay, no. Keep it simple. This is not reality, but always make those points. This is just a provision for tax. If by the time the business starts, right, this is being evaluated by the tax authority, is either the tax is more than this or below this. Keep it simple. Keep it simple, right? Yes, we want to expense this. No, don't do that. Make it basic. Basic accounting. You're not building a model for IFRS standard or accounting or everything. Keep it simple. Keep it simple. Don't go too much, don't go too deep. Keep it simple so that even layman can still understand what you've done. So by the time you are going to tax carried forward loss, tax this and that, then you know that you need to start asking a lot of different questions and different things. So let's keep it simple. So provision. So I'm going to use a logical. So instead of using if, I won't use if, I will use a logic, which is this. So let me bring my tax rate first. Did we build out our tax rates? No. So we didn't include that in our input. So let's just create that. Let's create that. Let's create that down here. So let me call this government. Government. So provision for tax. Provision for tax. Because if you build a model and you meet some kind of we have some crazy set of guys, right, that they are good and they are good at questioning almost everything. So I'm quite sure. Okay, so let's even just make this only one input. I'm quite sure the lesser you have, the better for you. But because the more you have, the more questions you need to answer, and you might not be able to just convince them of what you've done. Yes. I did a project, an ordinary whack cost of capital almost ruined the whole project, right? So there are there are so many things, right, that you just need to learn from experience. Work is very good, but the truth is most time it really does not apply to most startups. Yes, that's the truth about it. If you go through a normal calculation of corporate work, because a startup business, what where will you say you are, what is the base of their beta? Because that's one of the most difficult things, and beta is really powerful when it comes to getting a cost of equity, right? Because it kind of measure the volatility of how the business is. So for business that has no data, then you go and carry a company, a mature company that's already making 10 billion. You're now comparing to a company that's just trying to make 1 million. So there are a lot of things, right? There are a lot of things. Maybe those will be discussion for another day. Okay, right. So we are saying profit before tax, are you greater than 0? So that will give me false. Anything truth in Excel is 1, anything false in Excel is 0. Then I will now multiply this by what? My profit before tax multiply by my tax rate, which I'm going to keep constant, close the bracket and press enter, drag that to the right. So instead of using some if function, I won't use if function. So the profits, so profit for the period, so let's call this net profit. Saying okay, so we're saying equal to my profit before tax minus my provision for tax, and then we have this. Now this is looking this is looking great, right? Okay, so let's go ahead, let's build our balance sheet. Let's build our balance sheet. Let's build our balance sheet. Is it okay to consider minimum tax in a model? As I said, yes, there be some, definitely there are some lot of models that you build, whereas you need to factor in the tax and everything, right? Definitely that we have that. If you are dealing with some mature companies very well, you need to factor all those kind of things. But for a typical startup, it's better for you to keep it simple. Yes, because most time the user of your models, most of them are not really finance inclined and they don't understand most of these things. So just to keep it simple. But if you know that's something you can defend, you can go ahead and do it. Yes, 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 yes. Okay, so we need our assets. So let's be that. So we need our non-current current assets. Okay, all right. Okay. So let me do this. So this is what I'm going to do, right? So that you also get to do it. I just don't want to be doing it. It's very easy for you to see the way I'm doing it and you understand it. Now, this is what you are going to do. You build out your own balance sheet for this monthly period and also the cash flow on your own. You will now consolidate it into a yearly one. So I've created my profit or loss account like this. You will go ahead, create the balance sheet and the cash flow, and you make sure your monthly model is balanced. Then you now consolidate it into yearly. So let me do example for us. Let me do example of a yearly, how you consolidate this. So I'm going to just copy this and let me put it here. Okay, so let me put it, let me paste it as a link. So that's one that I don't need. Okay, so we have this, and let me show you how we are going to consolidate this. And the formula to use, so let me ask us, what formula do you think we can use to actually consolidate all this into a yearly model, yearly financial statements? What formula do you think we can use? What formula do you think we can use?
Index and match.
Index and match. Okay. Okay, so I believe we can use index and match, but I usually prefer some if. Some if kind of a little bit faster. Alright, so we use some if. So equal to, so let me start from here. Interest income equal to sum if. Now it's asking for the range. So I'll go to my model, right, and I'll select the year. I'll select all the years, keep it constant, comma. Then the criteria is the year I have inside here. So don't give me the sheet name. So the year that I have up here, which I'm going to keep constant, I'm going to keep the row constant. So by the time I copied it down, then what is the sum range? Come to my model, I can just select this is my interest income for this period, which I'm going to keep the column constant. So by the time I copy that to the right, everything is still looking straight. Then I have this, copy to the right, then I have this. Something funny is happening in this second year. The net interest income seems to be decreasing. Copy it down, and then let me just copy from here. So don't worry about that. We'll definitely do the adjustment at the end. So interest income minus what we're getting from savings. Then we have this. to happen in second year. Why is the interest income decreasing? Okay, so from 32, then it decreased in the second year. Why is that? What's happening? So let's look at that from our calculations. Is it decreasing? Okay, so it looks like our what really happened? Is it that savings drop? Okay, looks like our savings or something dropped from here. Total loan that we're giving out dropped. Okay, the number of businesses also dropped. Why is that? Is it that the number of users dropped? Okay, all right. So those are the things we take a look at later, right? But let's build out everything. So let me copy this formula. Copy it. Put it here. Put it here. Put it here. Right, for this. So it's very simple. Even if you want to have it quarterly, you can also create a quarter one, and it's just the same thing kind of apply as well. The same approach, the same method. So equal to my net interest income minus my direct costs. Then we have this. So I was hoping someone would notice something, but nobody did. Let's take a look. Let's look closely. We've actually missed out something. Let's take a look at this. Let's take a look at our model. We've actually missed out something. We've actually missed out something.
The management fee.
Exactly. So as a modeler, know your model such that in case anything is off, you automatically detect it. So we've left out our income from investment facility. So where should we put that? Where should we put that? Where can we put that? Where should we put that? Where should we put that? Okay, so maybe we should bring it under this and call it other income. Should it be other income? It's more of their core income, right? What do you think? Should we make it other income, or it should be on its own?
It's still part of our main business, right? Anyways.
Okay.
But you can come as a line after net interest income. Just management fee income or something. Because other income suggests that it's not related to the line of business.
I agree with you. So let's put it there. It's one of our core business, so I'll come in here. Then our gross profit will now be this. Will be the main interest income plus from investment minus this. So now profit. So this will be net interest income plus this income from facility, and this is way really too low. That's by the way. Let's make the adjustments. Operating domain, this, then EBITDA, will be gross profits minus our SG and here. Then we have this. For depreciation, you can just copy this, put it here. So our EBIT.
Hello, Victor. Please, I noticed you are pasting the figures. We are there linked without going through to the calculations to pick from.
Okay, so okay. Are you still with us? Maybe your attention was divided. So we are using a sum if formula, right? And we've used some cell referencing to actually log some columns and the rows. As I said, the consolidation is the least thing you need to do. Once we build out the model and you have the same layout, the same structure and everything, all you need to do is put the formula in the first row, and you can just and all you need to do is copy, just paste it. Don't worry, it will automatically give you the other line item, just as long as you have the same structure.
All right, thank you.
So even if you are building for quarterly or the same approach, you can also use it as well. So profit minus this, then you have our profit for the net profit for the year. So to be sure this is correct, let me go to my monthly model. Let me go straight to my last profit, my net profit for the last year. So let me look at the total here. Here's the total, copy it, come here, and let me paste it to be sure it's the same thing. So this confirm that your model is good. So this is the annual model. And you see, it's very, very simple. Once you build out the monthly calculation, transform it into monthly model. Your yearly model, you are not doing anything. In fact, go to your cash, you are not building it, just doing the sum if, sum everything, bring it. For the balance sheet will be sum if, but instead, so I'm just giving us a clue. Instead of this year, remember all the line item in the balance sheet represents ending balance. So you'll be selecting the ending balance, which will be the 31st December instead of the year. Right, so I've done one for us. So your own assignment against next session is build out your monthly model for your balance sheet, your cash flow, right? Go straight to your profit or loss account. We've done the one for profit or loss account. Go straight to your balance sheet, do the same thing, go to your cash flow, consolidate everything into yearly model, right? So then after that, that's where you can now go straight into building some analysis into your model, building some analysis, right? Because I said the main thing is what we've done. From there you can always go ahead. So now let me give us one website where you can also get some metrics that can be used to calculate your model. So one thing you also need to add in this monthly, we need to have our, so all these our users and everything that we've done here, we need to summarize everything into this our monthly model, do your ratio analysis, right? So if you can go ahead to that extent, that would be great. That would be great as well. So I will share the link with us, so more like the metrics that are related to a tech business. So let me share that in our chat box, so you can click there, read more on that, on how to work with how to understand the metrics applied to a typical fintech startup, right? So remember your assignment, go ahead, build out the balance sheet and cash flow. Make sure your model is balanced. That one is very important. Make sure it is balanced, then go ahead, consolidate it into the yearly balance sheet and cash flow. If you can take a step further, read through the link, get those ratios that are very those metrics that are related to fintech, use it to do the calculation. You have almost everything that you need to build out your metric. Then next session, we are not going back there, we just go straight to the analysis. Then I hope my colleague can come in to start the evaluation part of the model next session. So let me also save this file so that I can share it with us. So let me save it. Okay, yes, Daniel.
Victor, please, you are giving a clue about how to consolidate the balance sheet from monthly to annual. I didn't quite get
Okay,
that.
so as I said, for the income statement, profit or loss account is more like the summation of the summation of your business operation from a beginning period to a particular period, so it's a summation. But for the balance sheet is a snapshot, right? It's a snapshot at the end of a particular period. So it's more like you saying everyone should stop what you are doing. The accountant will go in and just snap that picture. So which means balance sheet represents an ending balance. So balance sheet is not a summation, it's always an ending balance. So if you see this, our sum, if we are summing everything, that's as long as you fall within the range of 2020 in this our monthly calculation, it should sum it together. But for the balance sheet will now be, instead of summing the 2020 here, it will now be as long as the dates, the model, the period end date monthly model is the same thing with what is the same thing with your ending dates in your yearly model, then you should do the summation. So it will now, so for the profit or loss account, it's summing everything that is within the range of, as long as it's seeing 2020 to this period, it's summing them. But for the balance sheet will now be what? To be the end month. As long as you are seeing 31st December, give me the value. As long as you are seeing this, give me the value. So that's for that. Okay, right. So let me save this file. Let me zoom everything back to 100. Because yes, my screen is a little bit large. So let me zoom it back to 100 for us. If I will share it. Okay, perfect. So you go ahead. Build out your own, complete the balance sheet and the income statements. Please, this is very important. The next session, if you don't get to submit the assignment, you might not get the link. Yes, to the wrap up and also the valuation introduction in the next session. So let me try and share the file. Let me share the file with us. And then let me, so for some of us that might not be able to see the link, let me upload it and share the drive link with us. Okay, so let me upload it so that I can share the link with us. So I'll be sharing the link now. Okay, all right, so I've dropped the link in the chat box as well for us. So please, let's try and let's get to do this ourselves. It's very important. You get to learn more when you do it yourself, and that's the best way to learn financial model. Right. So thank you, everyone. I believe it's been a very interesting and great session for every one of us, building out our calculation schedule as a whole and consolidating our profit or loss account into a yearly model to see the effects and the impact. So thank you, everyone, and if you have any question, clarification, you can just go ahead and ask. And also please, we plead that you just try and share any of the learning points on our LinkedIn status, right, so that people can know that we are really doing something great as well. Yes, and remember to at me, Victor Ogundele, and our bootcamp code timeout with Victor as well. So I've sent the code, so I've sent the file. Okay, let me drop the link. So I've dropped the link as well, so just click on it so that you can download it and save it on your computer. So thank you, everyone, and I'll be saying my bye for now. See us in the next session, where we just be doing the analysis part of it, and then we start with the introduction of our valuation, which I hope my colleague will come in as well. So thank you and bye for now.